Welcome back to Yuri's Box. In this video, I'll talk about the S&P 500. Is this a short-term correction or a bear market? If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So the short answer is, of course, I don't know. I haven't got the slightest idea. But what I will do is try to give you my my perspective on things. Okay, it's things I've noticed, things I've listened. I've listened to analysts that are bearish and bullish, and I kind of try to make my own idea on things, and hopefully I'll do a good job of explaining everything. So I'll start off by pointing out two things. Ever since the top on February 18th and 19th, we've seen for the first time in a very, very long time declining rates not being a positive for risk assets. Okay, and that is a very big change. That's a very big shift, because just take a look at, for example, what we had last year in April. Okay, so we had rates on the 10-year, just taking the 10-year as an example, go from 4.7. Let's look at from up until July 11th. Okay, from 4.7 to 4.6. From then on, from here, you had a rally of about 15%. Okay. Going further back, if you go at the end of October, at the end of 2023, going back to the 10-year yield, okay, we had this massive move, massive rally in bonds, going from 5% to 3.7, roughly a 25% rally on bonds, which coincidentally were a huge tailwind for risk assets. Like, just take a look at the S&P. Okay, from here on, that basically fueled the move in risk assets. Okay, so it was a big tailwind. The fact that rates were going down were a big tailwind. For the first time in a long, long time, we have a risk off, the classic risk off trade, where trades, stocks trade lower and rates decline. So what you have is rates declining for the wrong reasons, okay? So that's one thing I noticed. Another thing is that we had on March 6th, if I'm not mistaken, right here, we had Trump kind of talk back some of the tariff, some of the tariff talk. And even though he talked those tariffs back a bit, it still wasn't enough for the market to rally significantly. We did have a bounce on Friday, but that really came more on the back of the fact that the non-farm payrolls was not terrible, not great, not terrible, to quote a Chernobyl. So these two things I think are quite interesting, especially the first part. First part because, of course, we have the return to the risk-off trade, and the second because the fact that risk assets didn't really rally on tariffs being talked back really gives you insight on the fact that it's not only about tariffs. Okay, so the way the market is traded for most of this bull market is since the end of 2022, is because we've been in a no landing environment. What is a no landing environment? Basically, the economy just keeps chugging along fine. Okay, you have kind of the best of both worlds when it comes to inflation and economic growth. You have good economic growth. Okay, and it being good is actually a key, because you no longer have the jobs market being a source of significant inflation. like in 2022, just looking at the quits rate, for example, right here, and you actually had a disinflationary trend in place. Okay, so you had both worlds. Okay, growth and an okay disinflationary trend. And that has helped risk assets perform really, really well. Okay. And the fact that tariff talk was kind of walked back a bit and it didn't provide a boost, even a small boost to risk assets, really tells me that for the first time, the markets are really considering the possibility of a landing. Right now, I think again, are we in a recession? The answer is no. Okay. It could very well be backdated, but as far as the moment is concerned, it's best not to even go into that kind of to entertain those thoughts. What can we say according to that it's a slowdown? Things tend to point to a slowdown, as we've seen in the S&P PMI report. Okay, things are kind of coming out of we're coming out of the September to March uh, positivity, optimism, and it seems as though we're arriving in a place that is more similar to last summer because of many factors. And I think that there are really three things at play that we need to be considered. Before I move on to those three things, to come back to the original question, is it a correction or is it a bear market? So before I move on, it's important to recognize something. Bull markets and bear markets start with a lot of skepticism. Because when you're at lows, it is very, very hard to find reasons to be bullish. And I was one of them, okay? I put myself in the in that group because again, in 2022 I was just getting started in this whole world. And like I remember very, very clearly, it was around October when you started seeing those Bloomberg articles come out. 100% of economists are predicting a recession. Recession in 2023 is a sure thing. And of course, I believe them because when you're just starting out, the only thing you know is to follow consensus. But as the more time you spend in the market, the more you realize that consensus is more often than not wrong. Okay. Coming back to what I was saying, it is very, very hard to find reasons to be bullish when you're at lows. And it is usually at lows that you start hearing things like that. You start hearing things like, it's only going to get worse from now on. Like Nouriel Rubini, I remember him saying something like, it's another 40% to go. Okay. The opposite is true for the beginning of a bear market. It is very hard to find reasons to be bearish, okay? Now, right here, especially in this from January to February, there were signs, and there were definitely signs, and I spoke about them in the week when we got the hot CPI. It was actually my first video. I pointed out a lot of things, a lot of reasons why it paid to be optimistic about inflation, a bit more negative on growth. There were clues, and I showed the quits rate as a perfect representation of that. Okay, the quits rate. The way I treat the quits rate, if you haven't watched my previous videos, it's basically a survey of people's actions. It tells you how people are behaving, and people's behavior is usually much better than people's opinions, because people's opinions can be skewed by political leaning, what happened in the news, and all of the stuff. But if people aren't leaving their jobs voluntarily, it means that they think that they can't get another job because they don't see plentiful jobs. And so that is telling of the current state of the economy. Okay? Going back to the S&P 500. What makes a bull market? Let's go back to basics first. Bull market is a general uptrend with violent corrections. Okay, this is what how a 2-year-old would draw a bull market. Um, and generally speaking, a lot of people like to short bull markets, like to say, yeah, all right, we had a good run, but it has to top, it has to peak out. And occasionally the shorts have their 15 minutes of fame, but it's generally short lived. And you can really see that in April, where we had that, secondary inflation a narrative come up, and we had rate cuts getting talked back. You saw that in July with the yen carry trade kind of, get unwound a bit. But in general, you see an uptrend, people trying to short it and, have the 15 minutes of fame. But the trend remains intact. And you don't usually see the previous low get pierced, okay? It's a series of higher lows. That is the the ABCs. Now, what is a bear market? The opposite. You have a general downtrend followed by violent rallies and just a continuation of the previous trend. Now, the reason why I think it's still too early is because we have still too early to determine whether it's a correction, so it's still in a bull market, or it's just a rally, where we could see a rally in the future, is because we have a lot of underlying themes that are kind of plaguing the market. Okay, so let me get one thing out of the way. Could we see something like this? Absolutely. And the reason why I think that this right here has the potential of being, at the very least, a significant bottom for the next few weeks is because the jobs report came in not great, not terrible, as I said before. And a lot of people were expecting it to be exactly terrible. If on top of that you actually see CPI come in just a little bit cooler, I could easily see the S&P 500 go back up into this range and actually revisit the bull market support band. So have a 3.5 to a 4% rally, something like that. I could easily see that happening, but I wouldn't get married to it, because I think, as I said before, this move right here, that is just my opinion, the reason for it is that the market is potentially considering the fact that we might have a landing, okay? So what are the three things that are plaguing the market right now? Number one, tariffs. And I've spoken about tariffs before, and the worst thing for risk assets is uncertainty. Not having, tariffs being put in place, then being walked back, then, next week you have them, then you don't have them, is actually worse than having tariffs. Because if you have tariffs, at the very least, you know in what environment you're operating in. But if you have them and then you don't have them, and then you have them and then you don't have them, you have no idea what the future looks like. And that is one of the factors that, as long as it continues, it'll just continue to be a huge drag on risk assets, and it'll continue to be a drag on the economy, because companies can't plan big investments if they don't know what the environment looks like. Second thing is layoffs, government layoffs especially. And again, the way I look at layoffs, federal employees, isn't so much connected to the initial jobless claims. That is the direct effect. The way I look at it is that each salary that gets cut is a salary that isn't circulating in the economy anymore. Okay, so whatever is connected to that salary isn't getting fed anymore. Okay, and that's where you see a lot of economists saying things like, for every federal employee, you have 1 to 2 contractors potentially getting cut off as well. So it's really the indirect effects that it has on the economy. Consider restaurants, consider offices, consider contractors again, not having that source of income. Okay, that is how I think you should go around layoffs. And as long as that continues, as long as you see pressure on government employees, as long as you see the effort to cut spending, or at the very least not expand spending, okay, that will be a drag. The third thing is rates in the US, at the very least, I mean, coming down or even staying flat, and rates in Japan going up. What this will cause, and what it is causing, is a strengthening in the yen. Okay, so as the spread between the 10-year in the US and the 10-year in the Japan narrows, whether it because you have inflation coming back in Japan, or you have downward economic surprises in the US, that will fuel yen strength. And, I'm not discovering anything new here, but if you overlay the NASDAQ, okay, the yen and NASDAQ have a very, very good correlation, okay? See if I can make it fit better. Like that, okay? So whenever you see yen weakness, you see a risk on environment. And whenever you see the yen strengthen, you see risk off, okay? Another way of visualizing this is with if you overlay the US 30-year yield, okay? So whenever you see yen weakness, you see a sell-off in bonds, just as that risk on trade takes place. And whenever you see yen strength, you see a risk off environment. And as long as you see inflation become a problem in Japan, you'll see Japanese rates go higher. And if you see the slowdown continue in US, you'll see US rates come down, and that'll just push yen strength, okay? And that'll be another negative for risk on assets, okay? Just clean everything up a bit here. So again, you have these three huge themes that are plaguing risk assets. Now, coming back to this 2-year-old's drawing of a bear market, I've made the case for a rally. So right now, this is where we are now. I wouldn't be surprised if we see this, okay? Now, it'll be important to see the way economic data comes out, as well as how, politics, Trump and tariffs play out as well. Because if during this potential rally, it doesn't have to happen, but risk assets could easily just puke straight down from here. Like Bitcoin, at least on today's price action, hasn't been it's been far from positive. We've seen a 3.3% at this point of the day. But in any case, it could be a source of a rally. But given the fact that we have those underlying themes still at play, and if by the time, say the second half of March, we still have that environment at play, I think that will be a rally. If again we were to have a rally, it would be a rally and you shouldn't get married to that rally. It's not a rally you would marry. Because at that point, you still have the drags, the headwinds to risk assets, and the more those persist, the more it'll have a negative effect on the economy, and the more the likelihood of a landing, you know, goes up. The likelihood of a landing goes up, and of course, the fact that risk assets have to even consider a landing is by itself a concern, because that is not the environment under which we've been operating. We've been operating under an environment of no landing. But if all of a sudden you get woken up by the potential of negative news, well, your entire assumptions have to change, and that is the beginning. We've seen the beginning of that, I think, with this correction. So to kind of square everything up, we've had this, this downtrend. I think that the benign non-farm payroll report, as well as a potentially okay CPI report on Wednesday, it could make the case for a short-term rally up to the from the lows to the bull market support band would be a 5% rally. That wouldn't surprise me at all. But if during that time you see no further progress on tariff talk, no further progress on federal layoffs, and yen strength, it will just make the case for a continuation of the trend. So it pays to be cautious and it pays to be nimble. Because again, as I've said in my previous videos as well, sadly, we are hostages of economic data. If economic data continues to surprise to the downside, the probabilities of a landing, be it a soft landing or a hard landing, in the near future, continue to go up, and that is just something that risk assets will have to come to grips with. I'll make another video on the upcoming week where I'll go over what I expect for bonds and stocks, especially when it comes down to the next CPI report. But again, coming back to the first thing I said in the video, is this a bear market or a correction, or a potential buying opportunity, buy the dip opportunity? The short answer is I don't know. All I can say is that this potentially could be a source of a short-term bounce. But as I've said, as long as the themes that I've pointed out, so tariff uncertainty, government layoffs, and so fiscal tightening, and yen strength, as long as these three things continue to linger, it just makes any potential rally a sell the rally kind of environment, okay? And so a potential setup for another leg down. It will really depend on the way the economy holds up, I think. I know it breaks one of the golden rules that you never should follow politics and really pay relative attention to economic data, but sadly, given everything, that's where we are right now. So again, I wouldn't get married to any potential rally. We could see one, especially if CPI comes in at expectations, but that is for another video. Keep an eye out for any tariff talk. Keep an eye out for fiscal tightening in the form of grants getting cancelled, federal employees losing their jobs, and further job cuts, and yields in Japan going up because of inflation, and yields coming down because of potential slowdown, which will drive yen strength, which of course is another risk off signal. Okay, so I'll leave it at that. Summary of it all is there could be a rally, but I wouldn't get married to it. Okay, and as far as it's a correction or a bear market, you have to wait for the economic data. Okay, see how things are holding up, and hopefully I did a good job. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.